Let's do Ask Annex in the studio. We got Fred Coleman, a CFP and a wealth manager at Annex Wealth Management. Welcome back.
Thank you, Danny.
Yeah, we got Matt Morzy, CFP and investment team manager. Welcome to you.
Hey, Danny.
Question number one on Ask Annex. I am still working. I've got a 401k with my employer, and I've designated some of my contributions to the Roth 401k. Under the recent tax law changes, I am not required to begin taking RMDs out of my retirement account until I'm 75. Am I correct in understanding that beginning in 2024, I will not need to take RMDs from my Roth 401k? Does that mean that once they begin, the amount of my RMDs will be based on the totals in my retirement accounts, excluding my Roth 401k?
Starting in 2024, RMDs are no longer required from your designated Roth accounts in your 401ks. RMDs are still going to be required from all of your pre-tax accounts. The current age for that is age 73, but this will increase to 75 starting in 2033.
Next up on Ask Annex, when you max out your annual IRA contributions, what is the next logical investment vehicle?
First, you want to max out all the tax advantage accounts, so the IRAs, the 401ks, HSAs. After that, there's a few options. For most people, the brokerage account would be the logical next step because it gives you the flexibility to pretty much invest in whatever you want without any strict rules or rules as far as when you can access the funds. You can also look at stock options if your company offers those. If you can get a discount to buy some company stock, sometimes that can be attractive. You can also look at your company's 401ks for opportunities to do mega backdoor Roths, voluntary after-tax contributions. Depending on your situation, any of those could be a good next step.
Yeah, this is what I really think is cool about financial planning. Is there's so many different variables that you can pick from in terms of how to save and what's the right way to do that. And everybody's situation is really going to be unique to them specifically, whether it's traditional versus Roth, whether it's IRA versus 401k or HSA, and deciding what is right for that person. You know, how old are you? Are you close to taking money out of those accounts? You know, what that breakdown is so unique to each and every single person. That's one of the things I think that we really do well here at Annex, and it's just really cool to watch our, financial planning team and our wealth managers help clients out with that.
Ask Annex got a question for us. You head to our website, annexwealth.com. Look for the Ask tab. You don't have to be a client for that. Question number 3 on Ask Annex. I see articles again saying the 4% withdrawal rate is back. Is it?
Yeah, there's a lot of assumptions that go into that 4% rule, so I'm not really a big fan of following it because, again, like Matt said, it assumes everyone has the same situation. It assumes that you retire at a certain age. It assumes that you have a certain allocation within your investments. And most importantly, it doesn't account for some of those unpredictable circumstances where you'll need to withdraw more than 4%. I think it's more important to develop a flexible cash flow plan in retirement that fits your unique circumstance. So the math behind the 4% rule, most of the time it does actually work, but we know that retirement is more complex than a math equation.
Yeah, I think one of the biggest benefits recently into the 4% rule or things like that is fixed income. You're starting to get yield back in fixed income, over 5% in a money market right now. The 10-year treasury did hit 5. It's back down to about the mid-4s right now. But now that you're getting yield within fixed income, it's so much easier to hit some of those withdrawal rates. You're getting paid on that amount to have there. It's much more conservative than having to rely on equity market price appreciation in order to have the funds to be able to withdraw. So I think fundamentally it's probably a little bit easier than it was a couple of years ago to be able to get that, because when you think the 60-40 that we talk about a lot, that 40% of it actually is giving you something now, so it's going to really help that out. And especially as you get into retirement, you're pulling that money out, getting yield on the savings that you have, short-term bonds, money markets, really helps that be a little bit more practical than it was before.
And our final question on Ask Annex today, can you explain what a value trap is? And I've been seeing that phrase more and more.
Yeah, it's a great question, something that we talk a lot about internally. So what they're really getting at is when you're looking to buy an individual equity, you're looking to see what the valuation of that or how much you're paying for that specific equity. What a value trap really is when you think a stock is really cheap, but it turns out to be cheap for a reason, and that's that value trap part of it. You bought it because it was cheap. Well, it can go lower, and it could go even lower after that, and you're buying it because of that reason, and you turn out later on, hey, I got trapped because I thought something was a unique value there. The market is always telling us things. It's telling us what the forward-looking prospects for a company is. And sometimes companies do sell off because the entire market's selling off, and then you can find value in those unique companies. But if it's selling off for its own reasons, whether the fundamentals of that company are getting worse and worse, whether there's an economic issue ahead that's specific to that industry that it's in or that type of company, sometimes you end up getting trapped in some of those things. So when we talk to active equity managers that we deal with, or even guys on the team here as well too, that their fundamental job is to do equity research, they're always looking at us, hey, I think the stock is cheap, I think it's attractively valued from that standpoint, and we want to go in, but hey, we want to make sure that as it's trading, we're making sure we're not getting sucked into something that's just a false storyline.
Yeah, and I look at it like if you're going to buy a used car, right? The ad may say that it runs good, it has low miles, there's a good price, but then underneath the hood there's rust and oil and all those things. So, stock really isn't a good deal, even though the price may be low and some of the fundamentals may say that it's a good deal.
Fred Coleman, CFP and a wealth manager, Annex Wealth Management. Thanks.
Thank you.
Yeah, Matt Morzy, CFP and an investment team manager. Thank you.
Thank you.